Hey guys, welcome back to the channel. Recently, I have received a lot of requests from my subscribers to make a complete course on smart money concepts from the very basic to the advanced level. So, I posted a community poll to see if the majority were actually interested. And the poll results were extremely positive. About 90% of all who participated wanted to learn smart money concept. So, here I am, thrilled to present you with this new video course on smart money concept. The course is designed in an orderly manner to provide you with the most comprehensive understanding of the principles and strategies associated with smart money concepts. I'll be taking a very conventional approach, assuming that all of you are complete beginners to this topic. Keeping that in perspective, I will discuss the main concepts in greater detail, which is actually essential to build a solid foundation so that we can have a good understanding about the strategies that we can implement as a trader. This will in turn enable us to plan our proper entries, stop loss, and targets, thereby generating high reward to risk trades, which is the highlight of this entire SMC concept. I'm not even joking when I say high reward to risk ratio. We are literally talking about 10:1 or 20:1 or sometimes even a whopping 40:1 reward to risk ratio, which is absolutely insane. And that tells you how powerful these concepts are. By now, I have mentioned smart money concepts numerous times. But what exactly are smart money concepts? I don't want to bore you by giving the same old answer that these are techniques or methods used by large institutions, hedge funds, banks, etc., who are referred to as smart money due to the reason that they make smart decisions in the market, and most of these concepts are purposefully kept away from the reach of uninformed retail traders. But my outlook on smart money concepts is different. I like to view them as traps set by the big institutions to use retail orders, usually the stop loss orders, to generate enough liquidity so as to buy at discount and sell at premiums. Think of these methods as manipulations or stop loss hunting or liquidity grabbing or simply the inducement of retail traders to enter into wrong trades at the wrong time or wrong locations. I know these terms are a little over your head, but fear not, because we are going to deal with all these terms in the upcoming episodes, and I guarantee that you will love it. A lot of research, learning, preparation, and hard work has been put into making a very relevant course, and that too absolutely free of cost. I doubt if anyone would take all the pain to make genuine content for my retail trader brothers. So I request you to wholeheartedly like this video and support the upcoming videos also, and share all the episodes with all those who are willing to learn and improve their trading but don't have the money or means to do so. Also make sure to subscribe to this channel because it's free, and also enable the bell icon so that you will receive notifications when I upload the new episodes. So in this video, I would like to give an idea about the course structure and why you should learn these concepts. Then I will answer the evergreen questions like, which is the best market to trade SMC techniques? Will it work in the Indian markets? Which is the best time frame to analyze and trade smart money concepts? Or should we use the multi-time frame analysis approach? But before all that, I would like to take this opportunity to thank Wyckoff theory developed by Mr. Robert Wyckoff during the early 20th century. So you can think how old these concepts are. Actually, the whole Wyckoff method is based on the premise that the market is manipulated by a small group of traders, or so-called the smart money, who have the ability to influence market movements. These smart traders or institutions use their knowledge and resources, which include data about retailer orders and retailer behavior, and they use this information to accumulate or distribute assets before the public is even aware of their intentions. Or in simple layman terms, they manipulate the market to trap retailer liquidity. Smart money concepts or institutional concepts theory is improved by the works of Inner Circle Trader, Tom Williams, Steve Morrow, and a few others. Every now and then, these concepts are given a new look and some flashy names, but the concept still remains the same. Think of it like companies introducing their old product in a new exciting packaging, inducing you to buy these courses. So I urge you not to spend a lot of money on these expensive courses, because these series of episodes will be more than sufficient to understand the concepts and strategies. But I have an advice. I would like you to watch my courses on price action and supply and demand. The reason why I'm suggesting this is because smart money concepts, price action, and supply and demand theory are all interconnected and have a lot of similarities. It is just the terminology that changes. Most of the underlying ideas are the same. The crux of smart money concept is simply this. Markets are manipulated by big institutions and funds, and they use the liquidity of retail traders against them. Now, coming to the second question, why do you as a retail trader need to learn about these concepts? And is it necessary? Actually, I can give an answer to this question in a single sentence. It is just that if you don't know where the liquidity is, then you are the liquidity. Every move in the market is in some way a trap set for the uninformed retail traders. Most of the retail traders blindly follow certain strategies, patterns, and some even call themselves breakout traders while others identify themselves as reversal traders and so on. But until and unless you don't understand how and why a price move was triggered, you will remain as a tiny fish in the ocean being hunted over and over again by the big institution or the smart money. So having a good grab of these techniques can give you a boost to your understanding on how to track the liquidity and how to capitalize on it just like the institutions. You will definitely start thinking differently and view charts with a broader perspective. Because I strongly believe that every move or even each candle formed in the market has a meaning or a logic behind it. If learned and implemented in the right manner, these concepts will definitely take you to the next level. Now, another doubt that most of you might have will be regarding the type of markets in which these concepts can be applied. To be frank, these concepts can be applied on all those markets which have ample liquidity. So, liquidity in simple terms is the ease of buying and selling of an asset without much slippages, meaning that there are enough buyers and sellers available for the smooth transaction of assets. Now, the more difficult it becomes to buy or sell an asset, the asset is said to be less liquid. Now, how do you know if the market or chart you are looking at is liquid or not? Now, there are a few ways to find this out. The most simple method is to look for trading volumes. As you may all know, trading volume refers to the number of shares traded in a particular time frame or period. It could be for 15 minutes or 1 hour or a day or a week. A high trading volume indicates that there is a lot of interest in the stock or an asset and it is highly liquid. With this, we can say that most indices are highly liquid. So to answer your question, these concepts will work well in indices like Nifty, Bank Nifty, etc. But when it comes to stocks, you will have to compare the volume of a stock with its competitors to get an idea. And along with that, we also need to look at the bid-ask spread and the market capitalization of the stock. In simple terms, the market capitalization of a stock is the total value of all outstanding shares. So a higher market capitalization generally indicates a more liquid stock as there are more shares available for trading. On the other hand, the bid-ask spread is the difference between the highest price that a buyer is willing to pay for a stock, or it is called the bid price, and the lowest price that a seller is willing to accept, or the ask price. So a narrow bid-ask spread indicates that the stock is highly liquid as there is a lot of activity in the market and the buyers and sellers are very close in their pricing. But if the bid-ask spread is wide, then the stock is less liquid or there is less activity taking place. So if you are trading in the Indian markets, I recommend you stick with the top Nifty 50 stocks or maybe just select the top 10 stocks that you like from the Nifty 50 range of stocks from different sectors. And if you are a beginner, try your best to avoid mid caps and small caps because the price action may not always be that smooth and sometimes things may not work out. But the best markets to trade smart money concepts are Forex and crypto markets, which are open for almost the entire week, thereby providing a much smoother price action. But this does not mean that all Forex pairs and cryptocurrencies are equally liquid. There is Euro USD, USD JPY, etc., which are highly liquid currency pairs, and cryptos like Bitcoin, Ethereum, etc. are highly liquid. On the other hand, there are other currency pairs like CAD-CHF or PLN-JPY or even cryptos like KuCoin or Gatecoin, etc., which are not liquid. So in short, you can use the smart money concepts to trade Forex markets, crypto markets, indices and stocks, all of which having high liquidity. Now moving on to the second most popular question, which time frame should I choose to trade smart money concepts? To be absolutely frank, we need to follow a top-down approach. That is, we need to start our analysis from the higher time frames or the trend time frames to identify the larger market trend and mark the areas of values, and then move down to an intermediate time frame to spot nested areas of interest for refining our higher time frame analysis, and also to identify the market liquidity, and finally move down to a lower time frame to take a proper entry, set a stop loss, and place a suitable target. Now, SMC technique will work for all trading styles, whether you are a swing trader or intraday trader or BTST trader. It doesn't matter what your trading style is. I have already made a detailed video on how to select the proper set of time frames based on your trading style that you follow. So you can watch that video to know more about multi-time frame analysis. Now finally, let's look at how the entire course is structured. As I have mentioned earlier, we will go in depth into the most important smart money concepts as shown on the screen. Once you become familiar with all these terms and their meanings, we will discuss the application side by learning how to use these concepts for trading in the live markets. That is, how to implement these SMC strategies. We will also talk about the risk management part, where we will learn the entry stop loss combined with the proper exits to plan a high probability, high reward to risk trade. Last but not the least, I will also discuss an indicator that will make things very easy for you so that you don't have to analyze each chart from scratch. With this indicator, you just need to cross-check the validity of the generated SMC signals for trading. So that was just an introduction to all the upcoming episodes. I hope you are very excited, and I heartily welcome each one of you to join me in this journey. And you can show your excitement in the form of likes, shares, and subscribes. I will be back with the first episode soon. Till then, revise the price action and supply and demand concepts, which will make things very easier for you. I will see you guys soon, and it's bye from my side.